taken advantage of us. We never did anything, but now we're doing it to them and fairly, I'll tell you what, modestly. But we'll be taking, and we are taking in right now, 25% on cars, 25% on steel and aluminum, 25% on other things, and that'll be going up to 50, 75, maybe 100 in some cases. We have to get our pharmaceutical industry back. Once we establish that in another couple of weeks, it'll start roaring back. It's already roaring back because they know we're doing it.
Stop what you're doing. There's a financial firestorm raging in Japan, and it's putting the entire global economy on high alert. While many are fixated on US market fluctuations, Japan, with its gargantuan debt, is in an unprecedented emergency state. This situation screams two critical warnings that we've all been dangerously close to ignoring: the terrifying power of compounding debt and the absolute, undeniable limit to how much a nation can borrow before it collapses. This isn't theoretical. It's happening now.
Take a look at yields. The yield on the 20-year bond is higher, now at about a couple-year high, 5.11, after the 1 p.m. auction that pushed yields up on the long end across the board, really.
And the implications for every major economy, including yours, are profound. We're diving deep into Japan's crisis and why it's a terrifying preview of what could happen next. Japan's debt to GDP ratio is staggering. It is expected to reach around 240%. This means that Japan's debt is 2.4 times its annual economic output. Such a situation puts Japan in a serious trap. The level of debt is more than double that of the United States. This makes Japan particularly vulnerable. One of the worst things that could happen now is for interest rates to rise. If rates go up, debt repayments will become more expensive. This situation robs the economy of revenue that could otherwise be reinvested. It is a horrific scenario, especially as Japan is currently embroiled in a trade war with the United States. Recently, Japan's 30-year government bond yield hit 3.15%. This is the highest level in 30 years and a significant warning sign. When countries choose not to buy your long-term bonds, it usually indicates one of two things. They either believe inflation will become a problem, or they fear that the entire economy might collapse. This situation is compounded by the interconnectedness of Japan's markets with the rest of the world, particularly the US. The yen is one of the world's reserve currencies. As global investors pull out of US assets, some of that money flows into the yen. However, despite this inflow, bond yields continue to spike. This is not merely a currency issue, it is an economic issue. The ongoing trade war initiated by Trump is making matters worse for Japan. Japan's economic contraction. Japan's economy contracted by 0.7% in the first quarter of this year, after adjusting for inflation. This contraction is alarming and indicates that Tokyo is one leg away from recession. This data was reported before the escalation of tariffs began. Digging deeper into the data reveals that Japan is on the brink of entering a series of rolling recessions. In 2023, the country experienced 3 consecutive quarters of recession. While 2024 seemed to be a recovery year, the current quarter's results suggest another downturn is on the horizon. In quarter 1, private consumption stagnated, showing 0% growth. Exports fell by 0.6%, while imports grew by 2.9%. This rise in imports is not a good sign when your exports and private purchasing are collapsing. Business spending did rise by 1.4%, but given the current climate, this is unlikely to last. These figures indicate several key issues within Japan's economy. Production costs and demographic. Production costs in Japan are rising, making their goods increasingly expensive. Since January, the yen has been strengthening against the dollar. As a result, Japanese exports are becoming less competitive.
To me, the strong dollar means having the policies in place to the deserved capital flows and have confidence. But it doesn't mean that the price on the Bloomberg screen every day. And it also has different meanings in terms of bilateral.
Additionally, competition from Chinese exporters is intensifying. Japan's population dynamics are not conducive to sustaining domestic growth either. The country is aging rapidly. By 2045, the largest consumer class, those aged 15 to 64, will decrease from 60% to around 52%. The number of individuals aged 16 and below will drop to just above 10%. Meanwhile, the elderly population will increase from 30% to nearly 40%. This presents a significant challenge for Japan. Japan does not have the immigration policies that countries like the US and those in Europe do. There will be no sudden influx of new citizens to save the economy. As the population ages without a productive workforce, more funds will be required for Social Security. Japan has a national pension and healthcare system that is efficient. However, maintaining it requires substantial financial resources. In 2024, Japan's fiscal deficit is projected to rise to 3.6% of GDP, a notable jump from the previous year's 2.9%. While this figure is less than that of the United States, it still poses a considerable problem. The limitations of economic rescue. Many might wonder why Japan doesn't simply spend more to rescue its economy. The reality is that they cannot. The debt levels are too severe. Furthermore, inflation in Japan is notably high compared to other G7 nations. The Consumer Price Index, CPI, is around 4%, while the US and Europe are both below 2.5%. Attempting to save the Japanese economy through increased money printing could exacerbate inflation. This is the economic trap that Japan finds itself in. The larger the debt pile, the fewer options remain. Japan should be raising interest rates, but doing so would only worsen the debt situation. The Bank of Japan has been trying to deleverage for over a decade. Since 2010, the central bank has been in yield curve control mode. They have been buying a significant amount of bonds each year. However, in 2024, the Bank of Japan plans to sell off some of its holdings. This U-turn in strategy during a trade war is risky. It will reduce demand for Japanese bonds, as the largest buyer is stepping back. Trade relations and tariffs. Despite the money flowing into the yen, the underlying economic fundamentals remain weak. Inflation is a persistent problem. Japan is taking a hardline stance against Washington. They cannot afford to tolerate the tariffs on steel and automobiles. A 25% import tax would severely impact their profit margins and further damage exports. Japan has observed how China has navigated trade disputes and aims to adopt a similar approach. The bond market is unforgiving, and recent bond auctions have confirmed this reality. Japanese yields are climbing. The 10-year bond yield has rebounded, but the 20 to 40-year bonds have spiked to nearly all-time highs. Investors are hesitant to buy long-term bonds due to the weak economic outlook. Fund managers expect the Bank of Japan to step in to stabilize the market. This brings us to the two significant risks facing the US. Both the stock and bond markets are at risk of implosion. Japan's strategies and global implications. Japan needs to find a way to lower bond yields while investors are panicking. If the Bank of Japan resorts to printing money, it could be highly detrimental. Rising inflation could lead to an even larger national debt. This situation leaves Japan with limited leverage. They hold over $1.1 trillion in US debt. If Japan decides to sell off their bond holdings, it could have several implications. First, the US dollar could weaken as the yen strengthens. This would help alleviate inflationary pressures since Japan imports around 90% of its energy. Lower energy prices would ease pressure on bond yields. If Japan uses the funds from selling US bonds to purchase Japanese government bonds, they could further decrease yields. This is a basic principle of supply and demand. However, there are trade-offs. Selling US treasuries could strengthen the yen too much, further hurting exports. This situation presents a nuclear strategy with limited room for maneuver. Future outlook. As bond yields in Japan continue to rise, the implications for US investments become severe. The traditional strategy of borrowing in yen to invest in US assets is becoming less appealing. If the dollar weakens, investors could face significant losses. If Japan decides to sell off US treasuries, it could drive asset prices lower. The current situation in Japan is dire. In discussions surrounding the strong dollar, the importance of maintaining capital flow into the US is emphasized. However, under the current circumstances, attracting capital becomes increasingly challenging. The trade situation must be resolved for any confidence to return. Japan's Kato is set to meet with US officials to discuss currency issues. The intention is to allow Japan to maintain a weaker yen or to appreciate it gradually. If the US insists on aggressive measures, it could devastate Japan's export economy. The repercussions would inevitably extend to the US Treasury market. As Japan contemplates selling its trillion-dollar bond holdings, the stakes are incredibly high. The US cannot afford for this to happen. The interconnectedness of these economies means that actions taken by Japan will have far-reaching consequences. The question remains, will Japan choose to sell off their US bonds to survive? And will the US continue to apply pressure on Japan? These are pressing concerns that require careful consideration. The situation in Japan is critical. They face a multitude of challenges that could lead to significant global repercussions. The relationship between Japan and the US is more important than ever. As we navigate these tumultuous times, it is essential to stay informed and engaged. The financial landscape is changing rapidly. If you're concerned about your financial security and are thinking about investing, check out the first link in the description. It's the platform I use, Interactive Brokers. Click the link to learn more. Want to learn more about investing? Like this video and subscribe to our YouTube channel for regular tips, tricks, and insights.